Hello and hope you are having a nice day. Today we will discuss income which is deemed to be arise in India, and we are going to discuss all the income other than the business income. The reason is the business income has been dealt separately. The first question, to whom this knowledge is important? Obviously the students require to have this knowledge, especially if they are learning the taxation subject, because this is a core aspect which, and that knowledge is very much essential. Secondly, the knowledge of this is also going to be useful to all the foreigners or the foreign citizen as well as foreign residing Indian citizen to whom it is going to affect, as well as all the Indian citizen who are having a dealing with the foreign citizen, because they are required to carry out certain obligation and deduct the tax when they are making certain payment. So with this in mind, let us now come to the subject proper. Once the residential status is decided and determined in accordance with section 6, which is dealt separately, that how to calculate the residential status. The next question arises is the scope of the total income which is going to be charged under the income tax in accordance with section 5. So here we have to understand that on the left hand side we have decided the various type of the income which can be there, and the three next column is connected with the residential status. So if a person is a resident and ordinary resident, wherever in the world he earned the income, he is supposed to pay the tax here in India. But if the person is a resident but not ordinary resident, then any other income which is earning outside India, that will not be liable for tax here in India. And in the case of the non-resident, the two incomes are included and the two incomes are not included. The first one, income received or accrued or arising in India. That means any person who is making an effort to earn the income here within the jurisdiction of India, and all the income which is arising due to that effort, or the property which is located here in India. Take for example, a house property will be there, and then with any relation with that particular property, if the income is received in India, obviously it is going to be included for taxation purpose irrespective of the residential status. That means each and every person has to pay the tax if the income is received, accrued or arising in India. The next one, income deemed to be received or arising or accruing in India. That means actually the income is not necessarily received in India, but it is assumed that in certain scenario it will be considered as an income which is arising or accruing in India, and it will be included in all the status irrespective of whether a person is resident and ordinary resident, resident but not ordinary resident, or a non-resident. So the things which has been marked out in the pink, indicating that even if you are a R and OR or a non-resident, one has to be careful on this aspect. The next one, income earned outside India from a business or a profession controlled from India. Now let us take an example. A chartered accountant is having an office in India as well as in UAE, and he is practicing GST in both the countries. Now if a person, when he is practicing in both the country and he is controlling the business from here in India, so he sit here in India also, and he also visit his UAE office. Now if he is a resident but not ordinary resident, that means his stay is more than 120 days but less than 182 days, he will be considered as a resident and not ordinary resident. So his income, even which is earning in UAE, that will be included here Indian income tax, and he will have to pay the tax accordingly. But if he is a non-resident, that means he stays out of India or stay in India for less than 120 days. That means for all practical purposes staying out of India. So 365 minus 120 days. So is staying for more than 245 days out of India. Then he will be considered as a non-resident. And in that case, his UAE income will not be included in the Indian income. So once it is included, it doesn't mean he has to pay the tax, because there is a probability that he may be getting certain exemption, or he may be the tax-free income can also be there. But if you are a resident, an ordinary resident, you have to pay the tax on the world income. Now section number 9 provide this deemed income in India. So according to the section 9, whichever income has been stated to be arising here in India, then irrespective of the factual position or the other interpretation, it is assumed to be earned in India. So now let us look into each of this. So there are various types of income which covers under the 5 heads of the income when we do the calculation under the income tax. The first one which we are going to deal over here is a property or the asset or the source in India. Any income which is earned out of these 3 things, directly or indirectly, then that is deemed to be earned in India. Then next we are going to deal with the salary. The next we are going to deal with the dividend income, which comes under the income from other sources, as well as the business income. But the business income we are going to deal separately, and for that particular reason we are not considered over here in detail in this particular topic. Now once we are thinking of any property or any asset or the source in India, we can be earning regular income out of this, or it can be one-time income when we dispose of or sell that particular asset, and the capital gain income may be arising. Then a salary, if we are rendering the service here in India, then there can be a government service also which can be there. Dividend income we are already taking. Then other income can be interest income, royalty income, or the fees for the technical service. And from the 1st April 2020, another income has come in within this deeming provision, another deeming income has come. So we are also going to deal in the same. Now we will be spending quite a good amount of time on this particular slide, and request everyone to focus more, because once we understand this basic concept, then understanding all of the things will be much more easier. Now there are 2 ways of taxation of income all around the world in the various countries, and there are 2 rules are a residency rule or the source rule. So this particular 2 provision or these 2 concepts are there all around the world under the taxation laws. Now let us here deal with the India. When we talk of India, what is the meaning of the term India? So that has been specifically provided under the GST law, and that definition can be imported over here. That India means a territory of India as referred to in Article 1 of the Constitution. So when you go to the Article 1 of the Constitution, it says India means Bharat also. So it is a territorial water, seabed, and the subsoil underlying such water, continental shelf, exclusive economic zone. Now exclusive economic zone, take for example ONGC. Now ONGC has got various rigs within the water, and we can call it as a maritime zone in the Indian territorial water. Now this exclusive economic zone also is a part of India, even though it is in the sea. And any airspace above this territorial or territorial water, that is also considered as in India. So what is the 2 rules which are a principal factor in determining the taxability of the income anywhere in the world? One of the rule is a residence-based taxation, and the second way is a source-based taxation. So what is the meaning of the term residence-based taxation? The residence-based taxation where the income is taxed due to the reason of a person being domicile of that particular country, that here in a particular country means India, or a citizen of India, or he is staying a particular number of the days here within India, or his property or asset is physically located in India. And when the taxation is being done on this particular basis, we normally term it as a taxation on the basis of residential rule, or it can be on the source basis. The source basis of the taxation means where a person is taxed in a country on the income from the source in that particular country. So here that particular country means India. So if you are getting any source from which you are earning a money anywhere in the world, but if the source is here in India, then it will be assumed to be an Indian income. So on these two bases, the taxation is applicable, and we are going to concentrate on the taxation here in India. So first, a property or the asset or the source here in India, directly or indirectly. It means that it is a physically movable or immovable property. If it is located here in India, then it will be taxable as a regular income, as an income from house property if it is an immovable property, or income from other sources if it is an other asset other than the immovable property, or if you are earning by selling or disposing of this property, then it will be termed as income from capital gain. Let me take an example. You have got a property here in Mumbai and you are located in USA, and another friend of yours is located in UK. So when you are disposing your property sitting there in USA to a friend in UK who is paying you from UK to USA, but because the transaction has happened on account of this property here in India, you are supposed to pay the tax here in India under the head income from capital gain. And when we talk of the property, it means immovable property, jewelry, painting, and lot of other properties also will be taken into consideration. Now another concept which has to be, because arising is a dispute. So here in the photograph you can see that there are two brothers and the tree has grown near the fence. So one of the brother is saying that I want to tax you, or this particular fruits belong to me, because the tree from which the fruits are being generated is in my border. The other brother is saying, no, your fruits are coming in my border and it is absorbing the sun and the sunlight in my border. For that reason, this fruits is my income in my border, not in your border. So there is a dispute going on, that whether the fruits which has grown on this particular tree belongs to brother A or belongs to brother B. And this type of dispute is there across the world, because all the world taxation are following these two principles. So what the world people did, they came out with the double tax avoidance agreement. And the double tax avoidance agreement is nothing but it is an understanding between the two parties, or here it is two government. So when there is an understanding between the two government that we are going to tax this particular transaction in this particular manner, in this particular jurisdiction, then the income tax act has to be set aside, because double tax avoidance agreement rules income tax act. Now because of this particular provision, what was happening? Instead of avoiding paying a tax in either of the country, people plan out the affair in such a manner that they avoided paying tax in both the countries. So countries started losing the money. And for that reason, now they have come out with the multilateral instrument, which is a different topic by itself, from the 1st April 2020 as far as India is concerned, and India relationship with the other countries in the world. And when this happened, obviously double tax avoidance agreement still prevails. Multilateral instrument also is a new thing that also prevails. So whenever both the things are prevailing, the government come out with the synthesized agreement, which is a link between, or which contain the details of both the agreement. So it becomes very easy for a person to understand and bifurcate which income will be taxable under which jurisdiction and at what rate. So now let us deal with now income from salary. So question arises, how it will be taxable. Now this is on the concept or the principle of the source basis. The source basis means where you have made an effort. So when any amount is received due to the relationship of the employer and employee means the person who appoint you on the job or the service, he is an employer and you are the employee. Now that relationship, the amount is received by you, then that income will be considered as income from salary. And because you are making an effort here in India to receive the salary anywhere in the world, it will be considered as income from salary and it will be deemed to accrue or arise in India. So this amount may be received either at the moment of rendering the service, that means you are on the job, you are in the service, and instead of paying you here, take for example, you are on deputation by some foreign company to here in India. The employer is paying you the money in your whole home country from where you are coming. However, because you are making an effort here in India, irrespective of where the payment is being made, it will be assumed to be income earned in India and you are supposed to pay the tax here in India. And all the retirement benefit like pension, that also will be treated under this head of income. That means, take an example, you have done a job as a lecturer here in India. After completion of the lecturer job or after the retirement, you go and stay along with your children, say in Canada, and you get the pension income directly over there. But still, it will be assumed to be income earned in India because all the effort you have made here in India to get that particular pension income. So it will be taxable here in India, irrespective of the place where you are receiving the money. And if you are a government employee, then definitely wherever in the world you are deputed on the job as a government employee, you will have to pay the tax here in India. And we have to remember, government employees are different from the public sector company. So if you are an employee of the public sector company and after the retirement you go and stay somewhere or on the deputation you get the money somewhere else in the world, you are not supposed to pay the tax here in India because you have made an effort in that particular country. So that country will charge you on the basis of source of the income over there. But if you are a government employee, then irrespective of your place of working, you will have to pay the tax here in India. So government employee, who are the government employee? Generally, the post office employee, railway employee, or the local body of employee, or the state government employee, or sometimes as a statutory corporation like RBI. They are also considered as a government entity. And if you are doing a job over there, you are considered as a government employee. So service rendered in India means a person has to be physically present here in India. Now let us take this interesting case. Now in this interesting case, what has happened? There was a person who is a non-resident, who was a foreign citizen. He was sent by the company in the Panama and he was sent on the ONGC where the drilling operation was being conducted. And we have seen in the previous slide that drilling operation, if it is conducted even on the water and the person is constantly staying in the ship, which is there inside the Indian territory jurisdiction, that means it is an exclusive economic zone. Still, it will be considered as an India. So in this particular case, the person stayed in India for more than 183 days. So obviously he was resident. Forget about the non-resident. But what the court says, that because this employee was having a double taxation avoidance agreement with that particular country, and we have seen in the previous slide that when there is a double tax avoidance agreement, there is an understanding between the two governments that irrespective of the law, we will charge the tax on this particular basis. So even though his income was for an effort here in India, but because of the double taxation avoidance agreement, it was decided according to that agreement that if he pays us tax in his that particular country from where he has been deputed, Indian income tax will not be charged. So even the law prescribes for charging the tax, but over and above the law, there is a double tax avoidance agreement, and in accordance with the agreement, he was not supposed to pay the tax. So we have to keep in mind both the things, the charging provision or the deeming provision of section 9, and at the same time double tax avoidance agreement. Now let us consider the dividend income. Now dividend income generally arises whenever you are investing in the shares of any company, maybe a private limited company or maybe a public limited company. So if the company is making a profit at the end of the year, they distribute that profit among the shareholder, and that is termed as a dividend income. Under certain circumstances, even the loan to the shareholder is considered as a dividend income, so that also will coming over here. So a dividend declared by the Indian company and it is paid outside India, then even though it is paid outside India, it is assumed to be earned here in India. So Indian company means a company which has been formed and registered under the Indian Companies Act, 1956, or the Companies Act before that, and the Companies Act after that, that is Indian Companies Act 2013. So whichever the company is registered under any Company Act provision or the Company Act law, that will be considered as an Indian company, and if that company declares the dividend and it is paid outside India, it is assumed to be earned in India. And that company has to obviously be registered here in India, and the principal office of the company and the corporation of the institute has to be situated here in India. So from 1st April 20, as I told you, from 1st April 20, a lot of changes have come. One, the double tax avoidance agreement was there, and now multilateral instrument also has come. So synthesized agreement has come, and according to that, if there is any tax payable, then the source country will either deduct the TDS or withholding tax, and the tax has to be paid. That means the person who is paying a tax has to keep in mind whether he is paying the tax to any of this particular recipient. So from 1st April 20, a tax is payable by the recipient at the rate applicable to him, and that tax in the case of the foreign company at the rate of 20% has to be deducted. Then TDS will have to be deducted on the dividend on the following basis: anything to the residents at the rate of 10%, to the foreign institutional investor at the rate of 20% plus the surcharge, and to other residents at the rate of 20%. However, if the company is receiving a dividend and that company is a domestic company, and again it is paying out of that particular dividend to another domestic company, then in that case, because it is a dividend is passing from one domestic company to another domestic company, the recipient company don't have to pay the tax. But if the full amount is not being passed, then the amount which is written on that, the dividend tax has to be paid. So here another unique situation has arisen, that according to the double tax avoidance agreement, if the surcharge is there under the law, but as per the double tax avoidance agreement, it says that surcharge cannot be there, then even though the law prescribes the surcharge has to be there, it should not be there, as it was decided in the case of RAK Ceramics UAE. So this provision has to be kept in mind. Now let us consider the other income, which can be bifurcated into three categories: interest, royalties, and the fees for technical services. Short form is FTS. Now with regard to the interest, now any interest when it is payable on any debt incurred or any money which has been borrowed and used here in India, and the money has been borrowed from anywhere by any person, but the usage at the end of the day is here in India, then that income is assumed to be earned in India as per the section 9. Now various judgment has also included the other income, because if you remember, the section 9 very clearly says any income earned directly or indirectly. So in this particular case, in the case of the Vijay Shipping Breaking Corporation, the interest was paid on the letter of credit which was obtained, and the interest was paid outside India, and the credit was also given outside India. But still, because it is related with the business here in India, on that government said the TDS has to be deducted. Same thing happened in the another case where the interest was paid on the advance directly given to the supplier. So the foreign company has given this advance money to the supplier from the foreign borrowing, and he paid them indirectly the credit lending over there. So the government said, okay, you are indirectly giving a credit to the business here in India. So, and you are paying the interest outside India. So still it will be considered as an income earned in India, and the recipient is supposed to pay the tax here in India, and you are supposed to deduct the TDS. So that is a definition of the interest other income. The royalty we are going to consider in the next slide. Let us consider the fees for the technical service. So here it says fees for technical service means any consideration including the lump sum payment for rendering of any managerial service, technical or consultancy service, including the provision of service of technical or other person, but does not include the consideration for any construction, assembly, mining or other project. Now obviously this is not included here as a technical fees because it is included as income from business and profession, or any other consideration which is treated under the head salary. So something, if it is coming under the head salary, then it will not come under the fees for technical services. So this definition has been very clearly provided under the law. However, we have to keep in mind the double tax avoidance agreement, if it provides a different definition, that different definition will overruling this particular definition. So what does it say? Which income has to be considered to be an Indian income? If it is payable by the government, so any payment by the government is considered as an Indian income. A resident person for a business or profession within India, that means take for example, if the Reliance borrow the money from outside India, Reliance is a residence company. So it is having a business here in India and it is borrowing for the money for business here in India, and it is paid outside India, then even though it is paid outside India, it is an Indian income, and the non-resident will have to pay the tax on that particular income. Or any payment if it is made to a non-resident, if it is related for a business within the India, whether it is an interest, royalty or for fees for the technical service, in all the three cases this criteria remain the same. However, it should not be included in a non-resident income whether or not, shall be included in the non-resident income whether or not rendered service in India. So even if you are not rendering the service here in India and you are paying a royalty for a business here in India, or you are paying an interest or fees for a technical service, then even if you don't visit here in India, you are supposed to pay the tax here in India. Or a place of a business connection or a stay in India, that is also liable for taxation here in India. Now let us take the next one. What is the meaning of the term royalty? So royalty has been defined under the law. Royalty means consideration including any lump sum consideration but exclude any consideration which could be treated as a chargeable under the head income from capital gain. So if it is an income from capital gain, then it cannot be coming here under the royalty income. This bifurcation is essential because the TDS under the royalty is different, TDS under the capital gain is different, and the tax and the TDS under the salary is different. So each of this bifurcation is important to be understood. So here it says transfer of all or any right in respect of patent, invention, model, design, secret formula, process or trademark or the similar property, or imparting any information or giving any knowledge about the same. Take for example the various branded shirts which you might be purchasing, and if that brand is located outside India and here they give the franchisee to manufacture the shirt and sell it under that particular brand, and they charge the royalty. But because it is related here with this particular business which is carried out in India, on that royalty income it is assumed to be earned in India even though it is paid outside India. Take an example of McDonald's also. When you go for a McDonald's has got a particular process of selecting the potato and having a particular quality of potato, and then the chips are coming out in a different manner. So all these people, when they get the royalty for carrying out the business here in India, this will be considered as an Indian income. So even if you are parting up with the knowledge or the skill or any particular thing which they are teaching you, then it is liable to as a royalty income, will be coming as income from royalty. However, the exploration of the mineral and oil, that is excluded because it will come under the income from business and profession, which we are going to deal separately. Or any movie or any, take for example, if a person give a movie on the Netflix, and the Netflix people pay the royalty, and for that reason it is not a sale of the movie, correct? But because if it is a sale of the movie and other consideration, it is a business income part. But if you are getting a royalty for the same, then that will be liable for taxation here in India. Or any service in connection with the above, so that also will be taxable. Now let us understand one interesting case law. To understand the finer aspect with regard to this deeming provision, assumption provision, and what is an impact at the ground level. Now in this particular case, when we are dealing with the case, we have to read the section 9, which is a present deeming provision which we are under discussion. Read with section 195. 195 is dealing with the tax deduction at source. So section 9 says for a particular person, income is deemed to be accrued in India. Section 195 says that you are paying an income which is deemed to accrued in India, you deduct the TDS. And the article 12 of the double tax avoidance agreement. Now because this particular law, we assume that certain income is earned in India, which is not the fact. Because it is also earned by the other person somewhere in the foreign country. So obviously we have to look always into the double tax avoidance agreement, or now after coming of the multilateral instrument, the synthesized agreement. So in this case, what has happened? A payment was made, and that there was a treaty between the India, Malaysia, UAE, Saudi Arabia, China. And the law says that because you are paying this particular fees for technical service, for training given here in India, it has to be chargeable here in India, and the TDS or the tax has to be paid, and the TDS has to be deducted. The matter went into the dispute, and that was the reason why the judgment came. So SSC contained that the said service was not covered by the double tax avoidance agreement. So it was not covered by the agreement. And in absence of any permanent establishment here in India, no business income was there which could be liable in the tax in the end of the SSC. Now the question arises, when there is nothing there in the double tax avoidance agreement with regard to a particular service, can it be charged? So the judgment says that did not have the FTS clause, that is a fees for technical service clause. There was no question of taxability of such receipt under the Income Tax Act. Either as a business income or as an other income. So in absence of the clause, it says it will not be chargeable. In the same judgment, but there was another payment which was made, and this was made to the China person and Denmark, with whom they have got a different tax treaty. There the FTS clause was there, that means the fees for technical service clause was there, but without make available clause. So when it was without make available clause, make available clause was not there, but FTS clause was there. It was charged to tax here in India, and the judgment says that there is an obligation on the SSC, that means the person who is paying, to deduct the tax out of the such payment which is being made. Now what is the meaning of the term make available clause? The make available clause means somewhere by you are teaching through the technique. That means you are not coming here to give the technical service, but you are teaching the people over here to give how to give the technical service. That means you are parting with your knowledge of how to execute a particular job. Then that is nothing but a make available clause. And this make available clause, take another example. You must have heard about the Yevle tea of a Pune, which is a very famous tea house. So every Amrutal Tea Center has got a number of the branches or the franchises they have given. And even one latest is there in the Vasi. So where they are teaching the person how to make a tea. So that is nothing but when they are teaching the person how to make a tea, that means they are making available a technology. So when that make available technologies clause is there, then it will be chargeable here in India. However, the third part. So first part was dealing with the uh, Malaysia, Thailand, Indonesia, UAE, and Saudi Arabia, where the clause was missing, so it was not charged to tax. Another in the same type of agreement, China, Denmark, the clause was present, so it was chargeable to tax. And in the case of US, Sweden, the clause was present. The make available condition was there, but the make available execution was not there. And because make available execution was there, not there, it was said that no TDS has to be deducted. That means the tax, that income is not chargeable to tax here in India. So when we understand this particular judgment, we understand what is the limitation of section 9 vis-a-vis the article 12 of the double tax avoidance agreement, and the person who is deducting the tax, he has to take a sufficient care to understand section 9 as well as the double tax avoidance agreement in a particular case. Now a new deeming provision has come within the deeming provision, and that is from the assessment year 2021. And it says it includes the deemed income which is specified under 224(10). So following factors needs to be present. That income has to arise out of India. Amount is paid after 5th July 2019 by a person in India to a non-resident person other than the company or the foreign company. And it refers to the income under section 224(27)(a). That means any sum or money or value of any property exceeding rupees 50,000 is given without any consideration. That means it is given as a gift or nothing has been charged for the same. And there is an exemption also available. So in this particular scenario, what was happening, certain gifts were given by the Indian people to the foreign people or the foreign relatives or the foreign friends, it was not liable to tax in absence of this deeming provision. So now they have made a deeming provision that whenever any immovable property or even any other property like shares, security, jewelry, archaeological collection, drawings, paintings, sculptural or any other work of art, if it is given or the just money is given as it is to any foreigner by the Indian resident as a gift, then that gift is assumed to be earned in India and the person has to deduct the TDS, or the person will have, the recipient has to pay the tax herein. However, any such payment among the relatives is not considered as liable for taxation. That means if you are a relative as per the income tax definition and you are paying something to your foreign relatives, then that will not be liable for a tax here in India. It will not be assumed to be earned in India as per section 9. Now let us understand what is the meaning of the term relative. So relative means for an individual, obviously the spouse is considered as a relative. Then the parents of both the individual and the spouse is also considered as a relative. So the father-in-law or the mother-in-law and the father and mother, they are the relatives. So if they give the money to the individual or the gift, then that gift cannot be liable for the taxation under section 9 also, because it comes under the exemption of section 56. Or the brother and sister of the individual, of the parents, that means what you call as in Hindi mama on the mother side brother or buwa on the father side sister. Then if you receive the gift from them, you don't have to pay the tax because they are your relative. But you have to keep one thing in mind. They are your relative, but you are not their relatives. Because if mama receives the money, that means he becomes an individual and you are not a parents, nor you come in the definition of spouse, nor you come in the definition of brothers and sisters. So if it is your brother and sister, they are relative. But to your mama, you are not a brother or sister, neither you are elder to them, so they don't come under the definition of the relatives. Or the spouses of the brother and sister, they are the relatives. The children, the son or the daughters are the relative. The spouse of the son and daughters are the relatives, and the grandchildren or their spouse also can be considered as a relative. So any dealing between the relatives falling in this definition will not be liable to tax. But you have to remember, mama of yours can be your relative, but under the income tax you will not be considered as a relative if you are paying something to your mama as a gift. Then he has to pay the tax. Now this clause does not apply, as I told you, to the relatives or any amount paid to the foreigner at the time of the marriage, or any amount given under the will or the law of inheritance, then that will not be considered or liable for taxation to tax, or any amount paid in contemplation of the death. That means you are expecting that you may die, and for that reason you pay something as a gift to a foreigner because you are happy with the foreigner, then that will not be considered as a gift. Or any amount paid by the local authority, or any scholarship paid by the educational institute or the hospital or the medical trust, then that will not be considered as an income to the foreigner. Or distribution or partition at the time of HUF, that also will not be liable to the taxation. Or such class of person or such condition which may be prescribed. At this moment, no other class or no other condition has been prescribed, but whenever it is prescribed in the future, it will be tax. Now, as I told you, TDS also has to be deducted on the rate of such deemed income or the payment to the non-resident. So if any person is making a payment and that income is assumed to be a deemed income under section 9, then under given scenario, at the given rate, the TDS also has to be deducted. So first one, any payment from the provident fund exceeding rupees 50,000 is given in the hand of the employee who is a non-resident, 10% TDS has to be deducted. If there is a winning from lottery, puzzles, game or horse race, when it exceeds particular amount of 10,000 rupees, 30% tax has to be deducted. Payment to non-resident sports, 20%. Or non-resident sports corporate body, then also it is 20%. Payment of NSS deposit when it exceeds 2,500, 10%. Repurchase of the units by the mutual fund, 20%. Commission on the sale of the lottery ticket, 5% when it exceeds 15,000 rupees. Or payment of interest on the infrastructure bond, then again at the rate of 5%, the TDS has to be paid. And if the recipient does not have the PAN number, then instead of the 5%, 10%, you have to pay 20%. But wherever the 30% clause is there, then the 30% will prevail and not the 20% lesser rate. But if the lesser rate is prescribed and if the PAN is not available in the hand of the recipient, then you have to deduct the higher rate, that is. Now there are other various scenarios also whereby the TDS is required to be paid in the case of the individual and firm at the rate of 30%, by the corporate body at the rate of 40%. So whenever all this payment which is made, which has been prescribed under the law, in that case the TDS has to be deducted at the given percentage. Same way for the long-term capital gain, for the other than the long-term capital gain, in the short-term capital gain, the long-term capital gain may be either 10% or 20% depending on the scenario. Short-term capital gain on which the shares are sold through the share market and which STT has been paid, it is 15%. And all other cases, 30% or 40%. So if you don't come under a specific provision stated above, then the TDS has to be deducted at 30% or 40%. Besides deducting the TDS, even the surcharge is applicable at the various given rate. But as I told you, this is subject to double tax avoidance agreement and multilateral instrument as such, or the synthesized agreement. So if in that agreement surcharge is not specified, then the surcharge will not be deducted, only the basic tax will be deducted. Now, if you have got any suggestion or you feel any amendment is necessary, you may kindly send me the detail on the address given over here, that is knowledge@dalalca.com. You may also subscribe to my channel to know the income which is deemed to arise due to the business connection, because it is dealt separately. And now all the online transaction generating income to the non-resident is also liable to one equalization levy tax beside the income tax, beside the GST. So this is being dealt separately. So to understand everything in totality, it will be more advisable to subscribe to my channel and also go through my other YouTube presentation. While giving an explanation or doing this presentation, I have dealt on the conceptual aspect. I have dealt on the generality of the law. But if there is any specific circumstance where you required any particular clarification, you can email me and I will try to respond to the best of my ability. Thank you very much.